Welcome back. Our next guest says the confusion created by the tariff uncertainty creates pessimistic views of economic conditions on the part of consumers, and he's closely watching what executives have to say during first quarter earnings season. Joining us from Chicago is JJ Kinahan, CEO of IG North America. JJ, always great to touch base with you. I've read some of your notes, and I found it interesting that you've observed, like many have, a more pessimistic tone coming out of key consumer sentiment measures like the Michigan Consumer Expectations Index and the other consumer sentiment surveys. You're now watching to see how those dovetail or conflict perhaps with the views of chief executive officers who will be rolling out guidance and commentary before too long. Why don't we start there?
Yeah, so I think it's, first, thanks for having me as always, Paul. It's good to see you. But, you saw it in the comments this morning in the Goldman Sachs call by their CEO, David Solomon, talking about how the one thing their clients are really thirsting for right now is clarity. And I think that that's been the hardest part for most people to understand what is going to be tariffed, what isn't going to be tariffed. Obviously, seems to be good news over the weekend, particularly if you're looking at stocks like Apple, et cetera, this morning, in terms of the technology sector overall. But I think for everybody in life, one of the things is, I can play whatever game you want and figure out a way to get good at it, but I got to know the rules. When the rules change in the middle of the game, it's really difficult to be good at it. And so I think that that's primarily one of the things people are looking at. And Paul, how many times in years of my lifetime have you heard never give people more than 3 choices? Because as soon as you get a 4th or 5th choice, we know what that choice is, and it's 0. And so there are so many choices right now that I think it's a little discouraging for people in terms of what should I do next. And that's never a good place to be. The more we can clarify exactly what these rules are going to be, I think the more it helps every aspect of it. It's going to help the market, and it's going to help just individuals in terms of their spending habits.
One feature of this market sell-off is that bonds are getting hit as well as stocks. Tell us your views on why that's happening and what it's saying about investor appetite for risk assets right now.
It's really interesting that that's been happening. Now, one of the things that I've been hearing is this isn't because of one of the big worries is that foreign governments would back out of buying U.S. bonds. And so it's something to keep in mind. 15 years ago, foreign entities were about 50% of the bond market. That's down to about 30%. So that's helpful. But a lot more hedge funds are involved in buying them. So where we've seen a lot of the selling actually has been some of the hedge funds. There's been some rumors about one of the Japanese hedge funds that got in a little bit of trouble and had to sell down some bonds, et cetera. So I think that this is more a part of a risk-off trade from funds than perhaps government entities not believing in the U.S. longer term. It still needs to play out. And it's really interesting as one of the goals of the president, as he stated many times, is to get interest rates lower. And again, just a refresher for many of your viewers, as bonds sell off, yields actually go up, so rates go higher. We saw a 30-year mortgage here in the U.S. go back above 7%. That tends to be a little bit tougher for the housing market longer term.
Okay, one group of investors, or traders, I guess is a better word, that did well in this market volatility were the pros at Goldman Sachs, Morgan Stanley, and JP Morgan Chase. What's the takeaway for retail investors from the blockbuster trading numbers we saw at those 3 Wall Street giants in Q1?
Well, I think that if you think about Q1 overall, there was a lot of opportunity for people. And so I think one of the things that people have to keep in mind as they invest and or trade, what is your longer term goal? If you're somebody who's holding a stock for the next 3 years and you say, I'm going to stick with that stock, this should be a little bit of noise to you or an opportunity to, do dollar cost averaging as things go lower. If you're somebody who is more of a trader, this has been, volatility equals opportunity when it comes to being a trader. Now, it hasn't been easy, obviously, as they say, if it was, everybody would be doing it. The biggest thing I can say to most people out there is please stay very small in your investments when it's this type of volatility, because the movement is going to be so great. The tendency is that you're going to get shaken out. so to speak. So the smaller your trades are, the less you're going to feel. People say don't be emotional in this, Paul. We both know that's not true. Money brings out emotion in people. But the smaller your trade and the more you've planned for a bad case scenario helps to take some of the emotion out of it. And so it actually upsets me when somebody says don't be emotional. You can't help yourself as a human being, but you can do the things that help take the emotion out of it as much as possible.
Great advice. Let's go to a couple of names that you like in very difficult markets. One of them is Occidental Petroleum, OXY in New York.
Yeah, I see a lot of our clients buying this one right now. And to me, all this really is a synthetic way to play crude oil for those people who don't want to play crude oil futures, et cetera. And actually having some, related business things that are perhaps going well. But primarily when I talk to our clients, the reason they're buying Oxy is they see this as a very nice way to sort of indirectly play crude oil.
Okay, and one that you are cautious on, or maybe even a little more negative than cautious, Chipotle Mexican Grill, CMG. You've got this one as a sell.
Yeah, so our clients have been, you got to remember, for retail investors, usually about 52% of their trades are bullish. So when I see something like Chipotle, where almost 60% of their trades are bearish, that really sets off my alarms. And if you look at this chart, unfortunately, it's been not a pretty chart for the last couple of months. And so as the new CEO came in, there's a lot of believers, and he's a talented gentleman, but they're having to do a lot of things on the menu, and some of the tariffs may affect some of their ingredients that they use. So that becomes a higher cost for them overall. And in a restaurant business where margins are pretty thin anyways, it has been a concern.
JJ Kinahan, thank you so much as always. He's CEO of IG North America. Thanks, JJ.